Bitcoin is the cheat code. So what that means is that by just buying Bitcoin, I can outperform every other financial player, portfolio, fund, venture capital, private equity. I can just buy Bitcoin and not do anything else. Just buy Bitcoin.
Mark Moss opens with a statement that sounds almost too simple to be true. Just buy Bitcoin. Not trade it, not rotate into the latest hype, not chase gold, silver, or the asset of the month. Just buy Bitcoin. According to Moss, Bitcoin is the cheat code of the financial system. By doing nothing more than holding Bitcoin, an individual investor can outperform hedge funds, pension funds, venture capital, private equity, and actively managed portfolios, all while avoiding complexity. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Why is it that people keep not doing the simple thing and buy Bitcoin, but go for the hype and now chase gold and silver?
Well, I think there's a couple of reasons for that. I think number one, humans are emotional. We suffer from all types of biases like normalcy bias or recency bias. And so gold has been the best performing money for thousands of years, 5,000 years. And so it's normal, it's recent, it's old, the Lindy Effect, it's been around for a long time. And it's also done extremely well for the last year. So people always chase hot stocks or whatever. In this case, it's it's a commodity, but they chase price. And so gold and silver both did extremely well, better than Bitcoin last year. And so one, it's been around for 5,000 years, so there's this trust in the system. It's generational. And then two, it's been outperforming, and so they're chasing the price. I think, you said why gold instead of Bitcoin that's better, but not everybody understands it's better or why it's better or how it's better. And so really it's a generational thing. It's, why your grandparents aren't really on the internet, but your kids will never know a world without it. And so it's sort of like your grandparents would never buy Bitcoin and your grandkids will never buy gold. First of all, Bitcoin has gotten to one of the biggest global assets in the world in spite of governments attacking it its entire life, in spite of that. So it doesn't need government approval. It was born because we don't need government. It's permissionless.
True.
Permissionless money for a permissionless life. It was born as an alternative, as a reaction to the government's manipulation of money. And it grew in spite of the constant attacks. I mean, and the attacks have been there from day one. Maybe not day one, but for the last decade, right? We saw Operation Choke Point in 2017. It's been there. It's been there for a long time, but it's still grown there in spite of that. So it doesn't need it. Now, anything positive might help, but you're not going to kill it. We saw, under the Biden administration and the SEC, all types of attacks, the refusal to make anything clear about anything. And I would say that, with the next president, Trump, coming in, but even before Trump, right, we had RFK running for president, we had Vivek Ramaswamy running for president, and we had Trump running for president, and all three of them were Bitcoiners. So sure, we got Trump, but all three of the candidates were Bitcoiners. So what we've seen is a 180-degree shift of headwinds to now tailwinds blowing it forward. So we have the entire Trump, I don't want to say the entire, but most of the Trump administration, the Trump cabinet, are pro-Bitcoiners. Trump himself, meaning he owns controlling interest of DJT Media, has bought billions of dollars of Bitcoin. His sons, he built a real estate empire, but his sons have left real estate and they're building Bitcoin empires. Howard Lutnick, his Commerce Secretary, they're all Bitcoiners, right, with Cantor Fitzgerald, et cetera. And we have the Strategic Bitcoin Reserve that's still going through its executive order right now. So I would say it's a 180-degree shift. Now, is there still some infighting, and is there still some squabbling? Sure, whatever. The government's not a monolith, right? It's made up of hundreds of people, and they're all going to have their opinions. But I would say the headwinds have gone to tailwinds, and we're off to the races here. So I would frame that a little bit differently. As far as you mentioned specifically the Clarity Act, to your point, stablecoins and the banks being able to pay yield on that. Sure, the banks don't want to pay yield on that. Why would they? They love getting your money and not having to pay yield. So of course they're going to fight that, but that has nothing to do with Bitcoin at all. So I don't really see how that affects Bitcoin. I think the stable coins are complementary. I think they're complementary. I believe that Bitcoin is too volatile to be used for day-to-day money today for most people, 75% of the world lives on less than $10 a day. 75% of the world. So for them, they're not saving long term. And so, if I have to buy my food on Friday, I can't have the volatility price drop and I can't buy food for my family. And so we'll get there, right? I believe that Bitcoin becomes the medium of exchange phase in the 2030s, 2030 to 2040 range. So we'll get there. But as of right now, today, it's just too volatile for most people that are living hand to mouth. And so the stablecoin is a pretty good entry for them. Not just because obviously there's no volatility, well, it's pegged to the dollar, but also for the trust factor. So what happens is whenever you have a new technology, you have something called the diffusion of innovation, and it's a bell curve that shows how the technology gets adopted. And you have the true believers, and then you have the early majority, and then you have what's called the chasm. And the chasm is something that has to be crossed before the rest of the majority comes in, and it's mental. There's still a lot of people that think Bitcoin is magic internet money. And I can't trust it if I can't hold it in my hand and whatever, right? Even though dollars are all digital today anyway. But they could trust a US dollar stablecoin. And so what happens is it's like a gateway drug. It's like, I'm in Lebanon or Turkey or Argentina and like I'm dying with my local currency. Oh, I can get these US dollar stablecoins. They don't call them stablecoins. They just think they're like US dollars. They get them and there's like this inherent trust in there. And now they're starting to use tokens. They're starting to use whatever you want to call it, cryptocurrency in general. They're starting to use that. And then I think, maybe they have a little Bitcoin and stablecoins in their same wallet. And they're starting to ask, like, why do my stablecoins buy me less and less, but my Bitcoin buys me more and more? And over time, I think it builds familiarity. I think it builds trust. And I think eventually it leads people to Bitcoin. So stablecoins are good.
A major part of Moss's argument addresses a common fear in crypto. Do stablecoins compete with Bitcoin? His answer is simple. No, they're complementary. Bitcoin today is too volatile for daily spending, unsuitable for people living paycheck to paycheck, and not ideal for short-term transactions. That matters because 75% of the world lives on less than $10 per day. Those people need price stability to survive. Stablecoins solve this problem.
So when you go to Walmart or, well, we have Walmart in America, whenever you go to whatever store you have, right, you're going to use your credit card or your debit card, and they're going to get charged a fee by the network provider to receive that money. Now, typically it's 2.5%, 3%, but in some cases it's as high as 8%. So when you're a major retailer and you're running tens of billions of dollars a year in transactions, 3 or 4% is a lot. It's a lot. Mm-hmm. So they could do stable coins for like no cost. No cost. And if they could put 3% back to the bottom line on millions or tens of millions or billions of dollars revenue, that's a massive driver. In addition, with credit cards, a lot of times people would compare Visa to Bitcoin. Bitcoin's too slow. Look how fast Visa is. It's not a fair comparison because Visa isn't final settlement, right? If I swipe my Visa card, the merchant actually doesn't get the money for 3 to 5 days typically. But even worse than that, it's 6 months before final settlement, meaning I can charge my credit card back. And the chargebacks, at least in America, are a multi-billion-dollar problem. It's a multi-billion problem. So if merchants can, one, get rid of the 3 or 4% fees up front and have final settlement, oh man, it's a game changer. So I think the merchants are going to start pushing stablecoin adoption in a really big way, and that's going to be the big catalyst there. Now, to the point of what's the next event that drives people to Bitcoin, the reason why I would use a stablecoin and the reason I'd use Bitcoin they're just different use cases. It's like you want to fix your car. I have some tools. Like, which tool do you need? I mean, I don't know. What are you trying to do? And so again, as I said, right, like Bitcoin is so volatile that it's not going to help me buy my my groceries on Friday. That's like the stablecoin. So stablecoins are sort of taking this medium exchange phase where Bitcoin is sort of filling in this store of value phase right now. So what's happening is, as the governments we talked about continue to expend the money supply, continue to expend the liquidity, continue to expand the debt, our money's buying us less and less, and it's happening at a faster and faster pace. And so, as I said, I'll start to see that my stablecoins are buying me less, but Bitcoin's buying me more, and that starts to happen at a much faster pace. And shoot, I should probably get some of that Bitcoin in order to do that. So I don't know if it's so much of an event as it is a process. It's happening. The governments are starting to spend faster and faster and faster. For example, Gold just hit $4,600 US dollars per ounce. That means $1, one US dollar represents 1/4,600th of an ounce. When the Federal Reserve was created in 1913, it was 1/20th. 1/20th to 4,620. So that's over 113 years, that's 5% inflation. But that's over 113 years. Over the last 6 years, it's been 20%. So it's accelerating, and I think people are. It's the frog that's in the boiling pot, right? Where it's happening faster and faster and faster. So it's like that process that moves people over. So there's two main drivers of Bitcoin. Number one is inflation, so it's a store of value. But number two, it's authoritarianism, and so we need censorship-resistant money. And of course, Europe is going to push all types of people into Bitcoin. As soon as they roll out that CBDC, everyone's going to go to Bitcoin. So it's inflation and it's authoritarianism. The reason why you can't have a decentralized stablecoin, to have something fully decentralized like Bitcoin, that means, one, there's no rulers. There's only rules. That's a key piece, and you want to talk about Ethereum, so that's one big distinction. Ethereum is rulers. Bitcoin has no rulers; it has rules, which is a difference. So you need a set of rules. It's a protocol, and what happens is when there's a disagreement of what to do with the protocol with Bitcoin, you can fork it, like we saw through the block size wars, and we split Bitcoin, and we got Bitcoin and Bitcoin Cash, for example, right? And so what happens is, if I have one Bitcoin and then it forks, they make a copy of the blockchain, and now I have one Bitcoin and one Bitcoin Cash. So I have one of each. But in a stable coin, I had to deposit $1 to get the token. So you can't fork the token. You can't create more dollars out of thin air. So it's impossible to do that. So you can't really have a decentralized stable coin. If I've put up $1, how do you fork that and give me another $1 back? But it's not just that the dollar is losing value to the Bitcoin. The point is in order to get the stablecoin, I had to pledge $1 of capital. So you can't fork that and give me an extra $1 of capital. Where would that have come from, right? So that's why that won't work on a decentralized stablecoin. Now you can try some, like I said, some like algorithmic pegged coins where they're like running option schemes on call and puts that are trying to like hold it pegged. But I mean, we saw how well that worked with Terra Luna. Pegs are meant to be broken. Traders are always going to try to take those things down. So maybe it'll work. Obviously Sailor's doing that with Stretch, but it's not decentralized, right? They're manually sort of trying to keep that peg there, like what the Federal Reserve does.
Moss closes with a crucial distinction. Bitcoin has no rulers, only rules. It is a protocol. When disagreements arise, Bitcoin can fork, and holders retain their assets. Stablecoins cannot do this. To create a stablecoin, real capital must be deposited, and that capital cannot be duplicated or forked. Algorithmic stablecoins attempt this, and historically fail. Pegs are meant to be broken. That is why Bitcoin remains unique.